My name's Paul, and I'm from the Ironworkers Mid-America Funds. We're located in Lansing, Illinois, which if you take 80 and you go east, the last exit in Illinois is Torrance Avenue. And if you get off there and go north, we're right there. Okay, it's not too far away. If you have a rain day or you want to come in sometime on a day off, bring your spouse. As you get closer to this, we have meeting rooms where you can meet with people and talk about whatever it is you want to talk about. Are you going through a disability, or unfortunately if you're going through a divorce, or you're just trying to get all your ducks in a row, what kind of forms you need. You can come and visit us anytime you want. We're open 8 to 4:30, Monday through Friday. We're going to talk about the pension plan and probably your favorite, the SMA plan, which is the account balance plan. And I've got several people that are going to speak a little bit today. Again, my name's Paul, and I'm the administrator there. And I have Laurel, Jenny, Ashley, Alex, and Heather, who are in different roles, handing out packets and going to talk a little bit today. So, please listen to them when you're, keep your conversations to a minimum. Your district council, some of you may work only in 444, but sometimes if work is better somewhere else, and or there's a job that needs your particular expertise, you might go into one of these other jurisdictions up to Rockford in 498 or out to 111 in Rock Island, or into, God forbid, Indiana in 395, or somewhere down to Champaign or Peoria. But if you do, you make sure the money flows back to Mid-America and you get credit for everything you get. You have to go where the work is sometimes. Okay, as you guys know, your associations that are in this area get together with the union, and then you form a collective bargaining agreement, and it spells out how much you're going to make, how long is your lunch time, what is your grievance process, all those things. The most important thing is how much you make, and then the employers go out and make those jobs, hire you, and you're off and running. You pay a lot of money into your plans, and you have a health plan, you have money that goes into JTC and various other things, but the two big ticket items are the two that we're going to talk about today, the pension and the SMA. So think about the pension as the money you're going to get every month for the rest of your life. ACH'd right into your account on the first of the month, no matter how long you live. If you live to you're 95 years old, we have people in their 90s that are still getting a pension that have been retired for 30 years. You will get a monthly benefit from us. And then depending on what you elect at retirement, your spouse can get a benefit for your spouse's life if you die before your spouse. So we're going to talk about all that today. Now, I'm going to have Jenny come up, and she's going to talk a little bit about the packet you have. We put together a packet, since all of you are, maybe 5, 10, 15 years away from retirement. You got an individual packet, and it has a lot of things in it. But the two most important things in there are an estimate of your pension as of today, as of when we ran it in the last couple weeks, assuming you retire at age 65, or 62 rather. You may retire earlier than that if you want. You can retire as early as 52, 55, depending on your work history. And then the other one behind that is a statement of your SMA balance as of a week or two ago. Hopefully your SMA balance as of this moment is bigger than it was on that statement, because the market's been going straight up the last 2 weeks after just, going down a bit. So, but that happens. That happened when we were here in 2023. We printed these statements and the market was like 5% higher than what you were all looking at on your phones. So I'm going to turn it over to Jenny, and she's going to go over what is in your packet.
So on the left side of your packet, that's going to be the pension side. Your presentation is going to be on top. There is a place, every slide up here is in that packet. So there's a place to take notes on each page. So if something stands out to you, you can remember where it was and what we were talking about. Just below the packet, you're going to see a blue sample. This is not your personal information. This is just the example of what a quarterly statement looks like for pension. And behind it is the green, which is for the SMA. When you get these in the mail, they'll be on regular white paper, but please make sure to review your hours, the contractor, make sure you're getting paid and contributions for all the work you're putting in. You work too hard to have something get missed. And if something's not showing on there, give us a call at the fund office. We have a department, our delinquency department, that will go out and seek out those contributions on your behalf. Okay? And just below that, if you're not getting these statements, the yellow page behind it is our change of address. Everyone moves, things happen, and a lot of times we get forgotten about it at the fund office. So if you've moved in the last 6 months, just fill out one of these and bring it to us at the back table today so we can make sure we have your correct contact information and we're able to get in touch with you. And then on the right side of your packet, you're going to have this is a rollover form. So you have a presentation on top, and below it is this purple page, which is a rollover form. If you have another qualified plan outside of the SMA, but you'd like to consolidate it into your SMA, this is an example of what you'll have to fill out. There's a page for you and a page for the plan administrator of that other fund to sign off on that it's a qualified plan. And then you can roll all your funds into your SMA with us, which helps to cut down on fees and build that wonderful, keeps your momentum going as you keep growing and investing. Behind that, you're going to see our hardship provision. And I know that Ashley is going to talk about this a little later in detail with you, but this is the hardship plan that started in February of 2024 based on the Safe Harbor Act. And so if you have any questions on that later, also come find us because everybody's situation is so unique. We're happy to help you with that. Behind that, we've got your pension estimate request. If you want to know what your projected estimate looks like for a specific retirement date, fill out one of these and just bring it to us and we'll get that out to you as soon as possible. And the last page in there is going to be your contacts page. This is all the immediate numbers you kind of need when things happen. So just kind of put that somewhere you can always find it. And behind that is your beneficiary cards. The blue one is pension, the yellow one is SMA, and you're going to make sure you sign and date the bottom of the back of them. That's what makes them qualified. I want to talk about these for a second. So if you are married, even if you have put in beneficiary cards in the past, if you are married, your spouse is automatically your guaranteed beneficiary, no matter what. Okay? So for those of you that are not married, who are single, I have a story for you. So Jack and Jill meet. And they just have a really quick romance. They're having lots of fun, and they think they're falling in love. So she puts him down as her emergency contact, and he puts her down as his beneficiary on his SMA and pension, and everything's great for a couple of years, and then things fizzle out. Jill marries an independently wealthy man and moves to Hawaii, where she lives out the rest of her days. And Jack meets Diane, and they fall madly in love. And his parents love her, and her parents love him, and they decide to get married. And then Diane finds out she's pregnant too. And they're just planning out their future together, and it's just so exciting. And then one day, Jack gets into an accident on his way home, and he dies. And so devastated, Diane and Jack's mom come down to the fund office just to talk to us to find out what next steps are. And that's when we have to tell them that Jack never updated his beneficiary cards. And so everything he has is going to go to Jill, not to his fiance and the baby on the way. It all goes to Jill because that is the last name he wrote down. So if you've not looked at these in a while and you're not married, please get these into us. The situation happens more than we'd like to imagine it does. These are real circumstances.
So if you're married, you're okay, right?
If you're married, you're fine. If you're married, your wife, God forbid that happens and you die, she is going to send us a copy of the marriage license and her information so we can verify her identity, and then we will go forward with the path that's laid out according to the plan or whatever you guys have signed if you've already retired. But your wife is automatically your beneficiary, or your spouse is automatically your beneficiary if you're married. This is only happens when you're not married and something goes wrong. Any other questions? Yes?
What happens if something happens to both of you?
Okay. So generally it goes in order of, if you guys don't have beneficiary cards on file, then it would be the children. And then after that, if there's no children to speak of, it would go to the estate. And you would. So, yes.
Chime in on that same scenario. Would they just give it to the oldest child, or how would that
No,
work?
we have, it's called a sibling affidavit. And so if someone contacts us and they're one child, they have to actually take that page and go get it notarized stating there's no other siblings. Usually everyone kind of comes forward to let us know, and then we try to go around and make sure, or do our due diligence to make sure there are no other children. But we always encourage you to let your family know we're here. Make sure they have that contact page or they know where it is so they can call in and get all the information to us so we can be as helpful as quickly as possible, because it's such a tough situation when it happens. Yes, sir.
Is it just biological children or stepchildren as well?
I believe it's just biological. It'd be biological children. So
Unless
it's
you've
important.
adopted them
Like, if you've
legally,
yes.
then they're your children.
You know, or if you put them all down on your beneficiary card, then whoever's listed will get, that'd be your wishes then.
So even on the pension,
Yes.
they'll get your pension for X amount of years?
No, so
Or
what
not?
it is, there's a 36-month guarantee for anyone who's not your spouse. And it would be then 30, if you have a certain number of credits, they get paid out monthly at the rate you would have received. If you have not quite enough credits, they're going to get a lump sum that they can then roll over or pull out. Good question.
So, what if somebody's got a will already in place? Does the will-
Even if
does the
you-
will take over whatever
No.
is had?
Even if you have a will, that would be left then to your family to go along with the will, or your lawyer, whoever you've hired to designate that will. All we have are your beneficiary cards. We don't have access to your attorneys and your previous setup, because as far as we know, this is our law. This is what we go off of. So it would be up to whoever you've listed to then follow in accordance with your will. Now, some people do put trusts on file as a beneficiary. They'll list their trust, in which case you can provide us the entire trust document with that, so we legally can then say, we have this trust, everything's left to the trust. But as far as just a general will is concerned, that's up to whoever you designate to manage that will. And then you may want to put that person down on your card if that's who you're entrusting
So you guys can,
to carry that out.
you guys can use trust paper also if you send them.
We can put your trust on file if you send in the trust. Yes, sir. Yep. Yes.
They can put a primary and then a secondary
Yes.
beneficiary on the card.
Yep, there's a place for that. If you look at the cards, you look at the back, and you'll have a place there to list your spouse, and then also too, beneficiaries are listed below that. So there's contingent beneficiaries on there. And if you could always let us know if you need more. We can get you more cards.
Yeah,
Okay.
so these are really great estate planning questions at a basic
Yes.
level. Just to remember that anytime you put a beneficiary on an account, and you can put a beneficiary on every financial account you have, that supersedes the will. It goes directly to that beneficiary, and then your will gets read after that. So keep that in mind when you're planning your estate. If you want something to go direct to somebody without having to go through the hassle of court, put them down as a beneficiary. It goes straight to them, and that's
Yep.
what these guys are all.
It kind of cuts through all that red tape, like you're talking about, and makes it accessible, because sometimes people need that money to pay for the funeral costs or other things too. So it's important. So we're here to take these from you today also. So if you want to fill them out before you leave, take a few minutes and think about it. You can bring them to us in the back. We'll collect them all and make sure they get paired up with your file. Okay? Any other questions at all? All right. Thank you so much.
The pension plan's doing really well. In our most recent evaluation that gets done every year, we're at 93.6% funded, which is really good. I think in high school that's like an A-, bordering on a solid A. So you don't have to worry that the money going in here, something's bad going to happen, or it's going to go broke, or how rumors start, with things not going good. We've got the pension plan crossed the $1 billion level last year. That's 1 billion with a B. That's 1 with 9 zeros. And the SMA plan is getting close to $1 billion also. We're around like $920 million as of yesterday's close. So we're going to have two plans here with both $1 billion, and that's pretty incredible for a bunch of iron workers that started getting together in 1957 and accumulated money together. So it's been really good. Kevin and Jason and Matt, they're trustees on the plan, and we get together with all the other trustees, talk about the plan every quarter, review the investments, and talk about good things and bad things that happen. And so it's monitored very carefully, and there's actually 23 trustees involved, so those are big meetings, and we get a lot done. Okay, so now we're going to talk about the pension. I don't know if you guys and ladies, do you have a preference, like which one you think is better? Is the pension better, or is the SMA better? Did your philosophy change over time? Like when you were 30, did you think one was better than the other, and now actually you think the other one's better? Because they sort of serve two different purposes. The pension serves the purpose of providing you stability and money every month for the rest of your life. Takes care of the house, the apartment. Maybe your mortgage will be paid off soon if it's not already. Groceries, medical, all the things that you do on a day-to-day basis. And the SMA is designed to supplement it. Since you can take it in a lump sum, it's there for, non-traditional things. When you need to buy a car when you're retired, or you need some money to help out a child, or a large medical expense, you're out $16,000 and you got to pay that off. You can get in with your SMA to take care of those expenses, okay? Or just take money out monthly and you're on your merry way. Does one of them appeal to you more? Is it cool to see $1 million on your SMA statement, or do you think having $5,000 or $6,000 a month for the rest of your life, does that appeal to you more? I was just curious. Doesn't really matter?
They're both good. I just feel like people think that the annuity is theirs and the pension just goes upside down.
Okay, so that the perception, I don't know, when you look at the markets, you'd think you could lose 30% in 3 months, like when COVID happened. If you're in the stock market, if you're in the S&P 500, and you the first 3 months of COVID, your account balance went down by a third. So if you had $1 million, it went down to $700,000. Now it came back by July 1st, but your pension never went down during that time. Your pension stayed the same. So, there's good and bad. Just know that a long time ago, the trustees said, we want both for you. Some of you sitting here think you're really smart and you should put it all in the SMA and have this huge number, but then not have a monthly pension. And others may think, I'd rather have a big pension and then I don't have to worry. I'm not that good with money. I get nervous about the stock market. And so they kind of split the difference and said, we're going to give you both, and we're going to put a lot of money into both of them, and you figure out, how to manage it. So that's why the trustees, that's why you do what you do here. Okay? Now, on the pension side, you allocate your money pretty soon here when your contracts are finalized. But these are the contribution rates on the right-hand side. If you're working in the main zone of Joliet, 444, the contribution rate is $13.40 an hour. And then if you're working in the west, the north, or the south, that's what we call it. Those are formerly Aurora 393. You may be one of those guys. You may be a former LaSalle Peru guy. You may be a former Kankakee guy. You're a 444 guy now. And those are the contribution rates. They're getting closer. But regardless of which one, you're earning a fantastic benefit, and it's really based on the number of hours you work. Now, I'm going to go quick on some of these slides because it's not that relevant to you. Last night we had 35 apprentices here, and we went over pension credits and how you get vested. You got to get 5, and then you get 10 to get it at 62, and then you can retire early if you have 15. You guys have blown past that years ago. You guys can all retire pretty much whenever you want once you hit the right age. So I'm not going to go over too much of this. I will say that in addition to the credit you earn by the hours you work, you also get credit when you're not working if certain things happen. There's an hour bank system that's taken care of automatically. You don't have to worry about that. It's all built into your statement. If you're sick and you're getting weekly benefits from Tri-State, we can give you hours towards your pension. If you get hurt and you're on workers' comp, we can give you hours towards your pension. And then finally, if you go into the military or you already went into the military and it interrupted your ironworking career early in your life, or you were in Desert Storm for a year or something like that, let us know because we might be able to give you some credit for the time you were gone. You know, all the people that were in Vietnam and Korea, they've all since retired. And so it was a bigger deal back then. But still, there's some people that were in the military and we might be able to get you some credit. Okay, so generally, I just kind of blew through this. You need 5 credits to retire at 65, 10 at 62, and you all probably have 15 credits, so you can retire as early as 52 or 55, depending on when that benefit was earned. I don't know if any of you have contemplated retiring on a disability pension because your health is in decline, but if that happens, we can help you through that problem. You would need to be determined as totally and permanently disabled, and then you can get your pension right away. Okay? It's a somewhat rigorous process, but that is available to you if that happens to you. Hopefully that is not going to happen to you, and you can work on your own timeline till the day you want to stop working and get the best benefit you can. But if something happens, it's available to you. You just have to call our office. Okay? Now, the pension plan used to be a little more complicated than it is today. You were all legacy people involved in the old formula, and now there's a new formula. The old formula ended in 2020. And I'd need about an hour to tell you why we had these formulas and stuff, because there were a lot of reasons that people wanted these different formulas. But they were consolidated in 2020 to a very, very simple formula that has become the standard in a lot of plans right now. And that's called the percentage of contribution plan. And it's very simple, and I'm going to explain it right now. Basically, the hours you work are multiplied by the money that you worked it at, meaning the contribution rate, and then that is then multiplied by 1%. The product of those 3 numbers represents the benefit you earned in a year. So in that example, if you work 1,000 hours this year at the current rate of $13.40 and multiply that by 1%, you get a benefit of $134. So your pension goes up by $134 for the 1,000 hours of work that you worked this year. Okay, so it's a pretty simple formula. Now, you may say, well, what if I work more than 1,000 hours? What if I work less? The beauty of this formula is regardless of what you work, the formula is the same. It's just going to be smaller or bigger. You can see in that first column, the $134 is there. But if you work double those hours, say you work 2,000 hours, you're fortunate enough to be kicking butt on some 610s and you get 2,000 hours in a year, your pension that you earned that year will be double what it was for the guy that worked 1,000 hours. Okay, so that's $268. If you're fortunate enough to work even more of that, it's all proportional. The more you work, the bigger your pension. It's just like the SMA. If the person that you're next to works 1,000 hours, but you work 2,000 hours, your SMA contribution will be twice as big as the guy next to you. So the pension works the same way now. That was the main reason for the change. Now, the other way to make your pension bigger is by continually putting in bits of money every time you allocate your package. You do that every June. And you're going to do that again in a few weeks. I don't care what you put in. I don't get any more money if you put more money in. You want to put in 18 cents, you can put in 18 cents. You want to take a pass and put nothing in? That's up to you. Just know that your pension will only grow more if you put a little money in every time you have an allocation. This is an example of putting in a quarter, a nice round number, but as I said, you can put in whatever you want. And you can see that that year that you work those hours, your pension is incrementally bigger because you put that money in that year and every year thereafter. So a quarter might not seem like a lot of money. If you work 2,000 hours, a quarter into your SMA would be $500. But in the pension, it just increases your monthly benefit. So you just have to figure out how much you want to put in one plan versus the other. All I can say is that I would encourage you to always put money in all your plans to keep them going so you don't get behind, cost of living doesn't pass you by. How much you put in is really your decision. Some of you may like the SMA better. Some of you may like the pension better. I think it's probably true that maybe when you're under 40, you might be thinking the SMA is the way to go. And then when you're older and you start seeing that monthly benefit for the rest of your life is, $5,000. Some of you, it's $5,000 in this room. Some of it's $6,000. I think there's a couple with $7,000 a month. When you look at that and you say, I cannot go to work anymore, and I'm going to get $7,000 a month from my pension plan, that's a pretty good deal. Well, the fact is, you're going to get both of those plans, so you don't really have to choose which one's better. Both of them are going to be yours, and so that's a really good thing for people in 444. Now, this is an example of someone with about 30 years of service right now. So if you've been a worker for 30 years, your pension is going to be in the vicinity of $5,700 a month. If it's not, then you might have worked a little more than $1,750 on average, or you worked less than $1,750 on average, or you had a divorce which took some of your pension away, or you think you worked 30 years, but there were 5 years in the middle that you were doing something else. And so while it's been 30 years since you became an iron worker, you really didn't work all 30 years. Okay, so there's lots of different reasons why that might happen. Over the next 5 years, if you continue to work, you're going to earn another $1,100. So in 5 years, your pension might be, $68, $88 a month before any early retirement reduction, before any other reductions for any spouse benefit or anything like that. So there is a statement in your packet which shows your benefit. It's on the very last page of that one with your work history on it. And it says your single life benefit and 3 other forms of payment depending on if you're married or not. We don't know if you're married or not, so we assumed you were and that you had a spouse that was the same age as you. Okay, those are probably all bad assumptions, but it was just for illustration purposes in case you are married and we don't know about it. Okay? So I've said a lot so far. Anybody got any questions before I go further? Yes, sir.
The 1%, is that like locked in forever, or is that can go up and down?
It's locked in right now since 2010. It was higher than that at one time, and then we had some financial problems in the market that everybody had in 08 and 09. You'll remember a company that had been around for 100 years called Lehman Brothers went bankrupt, and it took with it a lot of other companies. But the short answer is that it's been 16 years now since that was done. The trustees are always looking at to see if they can improve that. But that rate, I think you can count on, is going to be the rate for a long time. Anything that you earned at a higher rate back in the day, you still have that. But most of the stuff you earn now is at 1%. Okay? Now, that's 1% a month, but it's really 12% a year if you look at it like an annualized thing, which isn't too bad. Okay, now, if you decide you want to retire early, early is before 62. You need at least 15 years of service to retire early. I bet you all have it. So I'm not going to go into what ifs. But right now, if you retire early, there's a reduction for your pension because we're going to be paying it out longer than maybe we thought originally. Anybody know how long your life expectancy is? Let's say if you're 62 years old, how long do you think you're going to live if you're a guy? It's something like 80, okay? If you're a woman, it's, I think, a couple years older. You know why that is? Well, it's because after he's dead, then she just chills and then she lives for 2 more years or so. That's why. Why are the ladies laughing at that more than the guys? Now, what matters in your situation is not what the average is. Nobody really cares about the average. All we care about is what happens for you. Think about how long did your mom and dad live? How long did her mom and dad live? Are they still alive? Are you in better health than they were? You know, your dad probably ate roast beef or gravy and a big meal every Sunday and never worked out. Maybe he smoked. Maybe he never exercised. I bet you don't do some of those things. Maybe you have a roast beef on Sunday, but you probably work out a little bit. You probably smoke less than your dad. You're probably exercising. You're probably going for an annual blood test. You're seeing a cardiologist. Maybe your dad never did that. So you've got a lot of things on your side, even before you think about all the medical technology that's here today that your dad did not have access to in the 70s or 80s. Okay? Same thing on the female side, too. So you have to think about how long you're going to live. Well, we have to think about how long you're going to live, too, because we're going to pay you a benefit every month from when you retire all the way till that end date, 12 months for every one of those years. Now, if you decide to retire early, we got to stretch your benefit out for extra years. If you retire at 55 instead of 62, that's 7 years. That's 12 months a year. That's 84 extra payments that you get. 84 extra payments if you retire at 55. So you pay what's called an early retirement reduction to pay for that. It's not a big reduction. You can see in that final column there, it's 85%, which means we take 15% of your pension as the reduction, as the penalty for retiring early. And that helps to pay for the fact that you're going to get 84 extra months of payments because you decided to retire at 55. So if you want to do that because it's still a good deal at age 55. Now, in this example that we were talking about with the guy that works till he has 35 years, if he retires at 60, his pension, there's no early retirement reduction. You can see at 60, it's 100%. It's not till 59 that it starts to apply a reduction. And the reason for that is because a year or so ago, the trustees made a benefit improvement. They improved the benefits so that there used to be a reduction at 60 and 61, but they wiped that out because the plan is doing so well. They were able to afford the ability to give you an unreduced benefit if you can make it to that age. But they also made some improvements to the factors, and so that the reduction, while nobody likes to pay an early retirement reduction, the reductions are actually quite small when you compare the extra benefits you're going to be getting. Sir?
2 questions. Back on the 1%, is there a chance that goes up?
Which 1% you're talking about? On the formula? Yeah, there's a chance it goes up. I will tell you that the trustees are always looking at ways to improve benefits. Okay? And when they talked about it a year or two ago, they wanted to attack this early retirement thing, and they wanted to make it easier for you to retire, if you wanted to, and so they made the penalties less. Okay? But the next time they might talk about that 1%, and then you might get an improvement that way. So the trustees talk about trying to improve the plan every time they get together. As I said, we're at 93.6% funded. They would like to get to 95, to 96, to 100, but it's they're balancing out, not being too generous, but still trying to get to 100%. So I would say, that they're always talking about that, and that might happen in the future.
Would it be like a quarter or a half, like 1.5? I mean, what was it before?
It was actually 2.75. Okay, so what they did was they lowered it, and they didn't make any other changes to the plan. They just went after that because that was the simplest thing to do. And I think if they ever increase it, they're going to increase it by, tenth or a quarter, something like that. If that's something that you're interested in, you tell your representative, and they'll bring it to the board, because there's always talk about improvements, and the trustees are just very careful to think about these things, because they certainly don't want to make an improvement and never have to take it back again. Okay? All right, good question. So this person, because he makes it to 60, there's no early retirement reduction, because it's 100% at age 60. So that's nice. Now, this is probably the most important slide today we're going to go over, if you're married, or you want to be married. And that is, those are two different things.
What if you are and don't want to be?
Or if you are and you don't want to be, or whatever. Okay, so this person, if you're single in the plan, you're offered just a single pension, and that goes forever, for the rest of your life, until you die. Till you're 80, 90, 100 years old, somebody calls us up and says, yeah, he passed away, we stop his pension the first of the next month. Otherwise, that money will be there in your checking account via direct deposit, okay? Minus any federal tax or minus any health care reduction that you want us to take out, but it will be there for you. If you're married, you have 3 additional options, okay? And those options are important. And so that's why I say think about retirement not the day before you're going to retire, but think about it the month before, 6 months before, a year before, and make your pension part of your overall estate planning, because it's very important, not only for you, but for your spouse after you're gone. Okay? Now, these 3 options, basically, you take less money than you could get as a single person, and then after you die, assuming you die first, your spouse then gets either 50% or 75% or 100% of what you were getting for the rest of their life. So in that very first example, the 50% option, you go down from $6,800 to $6,000 even, and then if you die first, let's say you live from 60 until 80, that'd be a pretty good retirement, 20 years. But your spouse is now 80 also, and her family history is that she's going to live 10 more years. Well, she will then get $3,030 every month for the rest of her life. And then when she dies, then it stops. Okay, so that's what you're buying for taking a reduction to your benefit. You're buying the ability to give her some money. So think about, was your mother or her mother in a nursing home at the end of their life? Think about, when you're gone, do you need to provide your spouse with some kind of income in addition to Social Security? Those are things that you have to think about when you're making these decisions. Yes, your SMA might be there, or you might have blown through the whole thing already. I don't know. So you have to think about that stuff, okay? In some cases, you may have a ton in your SMA, or you may own farmland out in Kane County, and you don't need to cover your spouse, because your spouse even has her own job with a pension, okay? And you say, I don't need to cover her, but I'll just do the single life. That's fine, you can do that. You just need her consent to do that, okay? It may turn out that this is everything you have, and you have nothing else. And so you want to maximize the money to her after you're dead. And the way to do that is to elect a spouse benefit. And if you want to provide more money to her, you elect the 75. If you want the maximum, you elect the 100. And that provides her the same benefit after you're dead that you were getting. Okay? So there's no right answer to this. One of these is not better than the other. They all have what's called the same value, the same actuarial value. It's just a question of how do you want to take your money. And that's why you have to think about how long you're going to live, how long you think you're going to live, how long you think your spouse is going to live. You have the opportunity to do some planning here. That's why you can't decide today to retire and put no thought into this, you need to think about it as part of your overall retirement plan, okay? Now, one thing you may be thinking about, the last column there. The last column is sometimes life doesn't work the way you want to. Sometimes the spouse dies first, okay? And if that happens, your pension will go up to the single life amount the month after your spouse dies. So you could look at this as you're buying insurance, you're both getting something out of it. You're covering her if you die, and then you get it back if she dies first and you don't need that insurance anymore. You get to go back up to the single life benefit. So you could look at it as though kind of it's a win-win for both of you, okay? We will never tell you what to do. If we get in a room with you and then you lean over and say, what should I do? What would you do if you were me? You know what? We're not going to tell you. All we're going to tell you is these are the things you have to think about and now thoughtfully make a decision. Okay? If you have $2 million in your SMA, maybe you don't need to cover your spouse. Or maybe your spouse is going to live a long time. Her mother died when she was 96. Well, you know what? It might be a good idea to cover her with a spouse benefit, because if she's like her mother, she's going to collect a lot of money over the course of her life long after you're gone. So those are the things you have to think about. The plan doesn't make money or lose money depending on what you do. We're just here to provide you with all of these options. And it's up to you to figure out which one you want to do. Okay? There's a lot of information there, sir. Good question. That's the most important question that is asked after this. And the answer is no, it can't be changed unless you get divorced. Okay? And the reason it can't be changed is this. Suppose you elect the single life option. You're going along, everything's fine, and you told your wife, yeah, you'll have the SMA, or I'll live a long time. And then you get cancer, and you got 2 years to live. Okay. Now at that point, you know you're going to die, and you're going to want another bite at this apple, but you don't get it because now you have knowledge about your mortality, and which you don't have now, and now you would make the decision that's best for you because you know something more now. And the only way this works is if it's a bunch of people that don't know how long they're going to live. Some will live longer, some will live shorter. And that's how these factors are developed here. So the short answer is no, you can't change your mind. Okay, if you get remarried, you can't add that person. It's not like insurance where you add the new person. If you're single now and then you meet the woman of your dreams on a cruise as a 70-year-old, you can't add her to your pension. Okay, it's too late. You can add her to your SMA if you want as a beneficiary. Matter of fact, you have to at that point, depending on where you are with the status of your SMA, because now she is your spouse. Okay? Any other questions on that? No? Okay, sir?
It's probably a weird one, but say you retired at that early 55, 56 because you could afford it or whatever, and then work's great and you're kind of bored of retirement, you come back to work.
Mm-hmm.
Is that...
Okay, everybody hear that question? You retire and then you change your mind? You know, there's such a thing as, I don't know if you've ever heard this expression, a honey-do list. And you retire and you realize you don't want to do that honey-do list anymore, and so you'd rather go back to work. That happens sometimes. We just stop your pension, okay? And when you're ready to start it again, we'll recalculate it for the additional stuff you have, and then you start it all over again. It's a little more complicated than that, but you can certainly do that anytime you want. I would suggest to you, never retire if you think you're going to go back to work. Okay? This is not intended to be I'll retire in the winter, and then when work's good, I'll go back to work. And it doesn't work good that way. You know, it's not meant to be a temporary retirement plan. If it was, it would say the Ironworkers Mid-America Temporary Pension Plan, but it's not. Okay? But people do change their mind, and so they go back to work, and that's okay. I hear there's going to be some more work coming up, so, you know, if you got an opportunity, even if in the summer you want to suspend your pension and, you know, work 6 10s at an Amazon plant or something, and and you don't mind giving up your $4,000 pension because you'll make way more in salary and SMA contributions and all that, you can do that if you're bored. You just let us know. You call us up and say, I'm going to suspend my pension, and you do that. But it's not an overall a great idea. You should probably wait to pull the pin until you really don't want to work anymore. Okay? Okay, sir?
Yeah, I got a question. So, I probably already know the answer, but, so say I'm collecting my pension, I got 2 checks, everything's good, me and mom go on vacation, we get in a car wreck, we're dead.
Uh-huh.
What happens to the money?
Good question. Let's talk about that. This is if you're married, okay? Now, the plan also has a guarantee of pension payments of at least 3 years, okay? Now, under the law, a pension plan doesn't have to have death benefits for single people. It only needs to have death benefits for married people. But we have death benefits for single people too. And so basically, there's a guarantee that no matter when you retire, somebody is going to get 3 years of payments, 36 months of payments, okay? Which I'm going to talk about why that is in a second. But let me buzz through these couple of things here. If you happen to die before you retire, your spouse will automatically get a pension. So you don't have to worry about retiring to lock something in or anything like that. Your spouse will get a pension. The law requires it, actually. If you die before you're 52, your spouse gets the 50% portion. So in this example, the spouse would get $30 a month for the rest of the spouse's life. If you die after 52, the spouse would get the 100% option. Now you may say, well, why is that? Well, it's because when early retirement used to be at 52, and we didn't want people to quick retire at 52 and lock in something, lock in a higher benefit in case they died. So the plan just said, well, once you make it to early retirement, we'll give you that higher death benefit in the event you die. So you're covered either way. You have a better coverage if you're 52 when you die, but you're covered either way. Now, the next death benefit is for single people. As I said, the benefit's paid generally for 3 years. Now, you may wonder, well, I put all this money in. Why is it only paid for 3 years? Okay, and that's the difference between a pension and an SMA account. The SMA account is your money. It's not $1 more or $1 less than what's in that account, okay? But a pension is something different. A pension is a promise to pay you a benefit for the rest of your life, okay? Now, some of you, that life will be very long, and some of it will be shorter. So the fund takes some of the money from the people that die younger, and it uses it to pay the people that live a long time. It's like an insurance policy, okay? That's why we get back to that 80, 82-year-old thing. If somebody dies at 77, let's say you died 77, it's before your life expectancy, so the plan will save a little money from that, and then some of that will go to the people that lived way longer than we thought, okay? That's the difference between a pension and an SMA. The SMA is you get exactly what's in your account, no more, no less. But a pension is a promise to pay a benefit for the rest of your life without knowing how long your life is. Some are longer, some are shorter. So that's why it's important to pick the one option that's good for you. Okay? Okay, on-the-job deaths happen. It's fairly rare. But I'll just say that the plan has a special benefit for a married person who dies on the job. Ironworking can be a dirty, dangerous business sometimes, and sometimes bad things happen. And the pension plan has a spouse benefit for someone that dies on the job that's over and above what we've talked about right now. Basically, we figure out if you had worked till you're 65, what would your pension be, and then we give the spouse that benefit for the rest of her life, regardless of any early retirement reductions or anything. It's just a nice kicker that she gets under the circumstances. Look, if you're involved in an on-the-job death, there's going to be lawsuits, there's going to be all kinds of things that happen. The last thing she needs is to worry about her pension. And so the plan provides this really nice pension to cover her during a period of time that's probably very traumatic. So that's just an extra thing we do if that happens to you. Okay? Okay, this is a dirty word. You remember George Carlin had that bit about the 7 dirty words that you can't say on television? Or maybe it's 11 now, I forget what it is. Well, this is a dirty word too. It's an acronym for Qualified Domestic Relations Order, which means you get divorced and you have to give some of your pension to your spouse. A pension is considered marital property like a house is, a car is. And so if you need to do that and you agree to do that, you have to sign a form that we can help you with and get it filed in the court, and then we'll take care of splitting it. Okay? So if you need any help with that, let us know. We'll probably save you some money and legal fees because we have a form that you can use that you can actually download off our website.
So if we have a member that's going through divorce or something.
You should tell them to call the fund
I'm
office.
calling you.
Right. Because sometimes their divorce attorney will say, yeah, I don't really do, I don't know much about quadros. I know a lot about divorces and stuff. If your fund has a form or something, I'll take it. That will probably save you some money than getting hosed by somebody that wants to charge you $5,000 for something we can give you for nothing. Okay. All right, so that happens. You may go back to work sometimes. And if you do, your pension's recalculated every January 1, and you might get an increase for the extra hours you work. You might not get an increase. And the reason is because the plan isn't designed for you to be retired and to take money out while you're still earning benefits. So you might get an increase, but you might not get an increase. So don't go back to work unless you, or I should say, don't retire unless you really think you're not going to work anymore. There may be opportunities to work after retirement, and those are separate, but don't plan your life around going back to work. Okay? Basically, you know the rules, 40 hours, that's the general rule. If you work over 40 hours in a month, you're going to lose some or all of your pension. Okay? So, if you want to tinker around, or you have an employer that's willing to let you go to work for a week every month, and you want to do that, you can work 40 hours. You can do that. You don't lose anything, but just be careful you don't go over 40. Otherwise, bad things happen. Okay? Any questions on that? Yes, sir.
Yeah, I got a question. Say you have an ex and she did the quadro and everything, but she's in bad shape and she doesn't make it.
Yep.
Where is that?
Okay, everybody hear that question? You have a quadro, and then some money went to, okay. Now, are we talking about the pension, or are we talking about the SMA? Either one? The pension. Okay, well, it depends on what the quadro says. If the quadro clearly said that if that person dies before she takes her money, it goes back to him, then it goes back to him. But that's generally not what they say. Generally, the money goes to that person's beneficiary, like if they have children or something like that. Okay? On the SMA side, it's even more clear. Once that money is put in that other person's account, that's their money and that's it. Okay? So it depends on what the quadro says, but generally there's no reversion back. Although I have seen it before, but it's rarer. Okay? Okay, we're here to help you. Our total existence in life is to help you in your pension and your SMA. So, all right. So I've talked for 55 minutes. I should tell you we're recording this on audio tape or digitally, and we're going to try to put it on your website or a link to your website at some point in time so that you can hear this again. It's for education purposes. We've done this at 395 in Indiana. We did this at 63 in Chicago, and next 2 weeks we're going down to 112 in Peoria, doing the same thing. So look for that soon. It's on our YouTube channel, which is at Ironworkers Mid America, all one word, and there's a hyphen in between Mid and America. So you can go there. There's lots of good stuff there, and you'll see these people in the videos and stuff. It's pretty informative. So. Any questions on anything? I blew through this fast, sir.
Pension beneficiaries, as a single person with no dependents. Who can that be?
It could be anybody. You know, a lot of times, you know, when an iron worker starts out working, he's got nobody. He puts his mother down as his beneficiary. You might have done that on your first beneficiary card. You can put down anybody. I don't think you can put your cat down, but I think you can put down, you know, charities. I think it's usually just people. You know, you can do pretty much whatever you want. We will honor it. Okay? Your cat does not have a checking account, so we can't give it to your cat, unless your cat has a checking account.
So if I put down like a beneficiary and a secondary beneficiary, so for example, I'm married. I want to take the 50% or the 100% for my spouse, but then if she dies before me, would I would be able to revert back to the single life
Okay.
price if I still have a secondary beneficiary?
Okay,
say, like,
forget about beneficiaries for a second, okay? All right, so if you elect this thing here, and you go along and you took the 100% option, is that what you're saying?
Yeah.
Okay. Now, if you die, your spouse will start getting the spouse number, 544150, okay? Now, if you both die before that guarantee that we talked about before of 36 months, say you get 5 payments of that number, and then you die, and then she gets 5 more payments of that, and then she dies, there's going to be, 36 minus 10, there's going to be like 26 payments of something out there, and that will go to your beneficiary because now both of you are dead. Okay? You'll have to write down on the card, you know, who that person is, and then we will contact them and make sure they get those other 26 payments. That's how it works. And then if the same thing happens with the SMA, they will get the SMA too. You can put down different people on the SMA. It doesn't matter. But the primary will always be your spouse on both of those plans until you're both gone. Okay? Sir?
I have a follow-up to that same one. So say I took the 50% option, $800 a month plus roughly less. She passed away first, you revert right back to the single life price. That, say we both live for 10 years, that 10 years though, that $800 deduction just goes away. Do you get that back? Whatever the reduction is?
Well, so you're saying you're getting the 6,000, right? And then how long do you live after that?
Say we both live 10 years and she passes first.
Okay.
I automatically go back to the 6,800, correct?
That's right.
But all that other money in between is just gone.
Right, because what you were doing during that time is you were buying insurance in case it didn't happen the way you said there. And so that money's gone, just like when you buy a term life insurance policy, you know, that nobody ever dies, you've lost those premiums, it's gone, okay? Now, there won't be any guarantee left for anybody either because you both collectively got more than 3 years of payments, it's gone at that point. Okay, and that's the difference between a pension and the SMA. The SMA, you know, if you haven't done much with that money is there for your next people, but the pension's gone because you got the money that you were promised. Okay. And that was another question, sir?
Yeah, from Aurora, 30 years ago or so when I started,
Yeah.
I want to say I filled out one of these.
Uh-huh.
I don't remember, so if I do a new one, is this one gonna?
If you do one today and you're single,
No, I'm married.
you're married.
Yeah.
Okay. Well, you don't need one to do one, but if you want to do one, you can.
I don't remember which one I picked up.
Sure. Well, you can call us on Monday and we'll talk about it. We have it on file. We have it scanned in our computer. We'll pull it up right away. Are you married to the same person?
Yeah.
Okay. So there's no issue. If you want to fill out a beneficiary card for the secondary people, you feel free to do that. We'll accept it, but we won't do anything with it because we know that the first person is there, and it will only take effect if that first person is gone. Okay. That makes sense to everybody? Okay. Sir?
It might be a good idea for anybody married that has children to put their children down as
Well,
right? If you're going to do that,
we'll-
if something
we'll-
happens to you and your
We
spouse.
talk about that, but as Jenny said, that will automatically be where it goes if you don't do that. Let's say you're married and you never filled out a beneficiary card, or you put your wife down when you got married and then you know she died. When we start looking for beneficiaries, first we look for a spouse. The second one is children. So it will get to your children. Now, if you want to do something special with your children, you know, like one of them is this stockbroker and this other one's a school teacher, and you want to do something different, you know, that's fine. If one of them is, you know, a child from a second marriage that you never legally adopted, but you want to treat that child the same as your own child, you know, you could put that down, and we will honor that. But that would have to be in writing, because as we said, it's only your legally adopted children. Okay, sir.
If your beneficiary moves, do you have to have a change of address, or will you guys find them, say if it's the name and the social security number? Are both
Yeah,
the same?
we'll find them. We have search systems where we'll find people. You know, you can't escape the world.
Yeah.
It might take a while to find them.
Yeah.
It's always better, you know, if you're going to change your address, it would be nice to tell us if your kid changed the address too, so we can get them the money faster. But we'll find them eventually, unless they move, you know, to Europe. Then it might be harder.
As a single guy with no dependents, the beneficiaries, does that automatically go to your parents or your brothers and sisters?
It automatically goes to, if your child, if you don't have children, it will go to your estate.
Okay, if you don't have anything written down.
It will automatically go to your estate. So we will contact somebody in your family that says, was an estate opened up on your behalf when you died because your stuff had to go somewhere? It's going to go to that somewhere. So figure that out. Or either that or just sign a beneficiary card so we don't have to figure it out. And that's why we don't have to get involved in wills or anything. We do what you say on the card, and if you don't say anything, then we just start looking for spouses, kids, and estate. That's all we do. Makes it simple. Because we're not going to read your will and try to figure all that out. That's a waste of time. Okay, sir?
When you hit your retirement date, how long do you wait for your first pension check?
Well, good question. If you come in today is the 18th, all right, and you're still working, and you say, I'm going to work till April 30th, you will not get a check on May 1st because it's just physically impossible, okay? If you can get everything done timely, you know where your birth certificate is, you got married in Vegas, and you got to find that marriage certificate, you got to find some other stuff. You can't find your Social Security card because it got washed and wrinkled up, and you need to get another one because we want to make sure your social is the right one because we have to report things to the government with taxes. Maybe if you can get all that done, you'll get paid on June 1st. You'll get a double check for May and June, and then in July you'll start getting your single check, one check a month. So that's usually how it will go.
2 to 3 months, just because sometimes the office is very busy and sometimes not. So 2 to 3 months usually gives you a good time frame to get that first check when you're counting on it.
But if something goes wrong, like you're divorced and you never did anything with that, all bets are off. It could take months at that point because we're not going to pay you anything until we know that it's still yours and not somebody else's. So, any other questions?
You can apply before your retirement date.
Yeah.
Too. You can apply in advance and write down that future retirement date. So you have lots of time.
You can actually apply up to 6 months in advance. Okay, no earlier than 6 months, but 6 months in advance. And that will give us plenty of time. So if you're working all the way up to retirement, we'll send you your first check probably right on time, but it won't be the final amount because your employer didn't remit everything yet. And a couple months later, we'll true it up, and then you'll get all your money. Okay? So Social Security likes the same thing. They're much more inept than we are. That's why they need 6 months, but we suggest it also.